Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Adamiec, or Dr. Rowe and Dr. Alpha. We like to give our names ourselves something that sounds like trader speak names. Today, we're going to talk about something that is near and dear to a lot of academics, a lot of academics' hearts, maybe not a lot of students' hearts, because it's one of the first things you learn in a derivatives class, and I know how frightening derivatives can be. But we're going to talk about agricultural futures contracts and the behavior of them, a little bit of history behind them, but how they really are a pure look at supply and demand. Supply and demand, we learn in freshman economics. It's a little, you could question some of the theories and say it's more academic than real world. In the agricultural markets, the supply and demand, it's very, very real world. And with that very long introduction, I'm handing it off to Dr. Al.
Yeah, thank you so much, Dr. Rowe, and thank you all for joining us. And if you like this, please hit like. And if you haven't already, please hit subscribe so you can see when our new content comes out. And as Dr. Rowe was discussing, this is actually weirdly one of the few products that are pure that can show up in a perfect competition. So we're going to get into what that means. We're going to talk about a little bit of supply and demand. We're first going to start talking about what a futures contract is. So this is a unique cross-section of when we start to think about the topics in economics as well as the topics in the financial markets, specifically the derivatives market. And I think that's something that's really important to think about. Okay, let's start at the beginning. So we will be looking at futures contracts in agriculture. We'll be talking about what a futures contract is. We're going to speak very, very briefly about pricing because this is not a time value of money, but we will be talking about what it means for that cost of carry. Okay, because that's an important concept. Why is there a discrepancy between today's price and a price in the future? And then we're going to spend the majority of our time really on this idea of parity. What forces those prices to be in line with each other? And we're going to look at an example when there's some deviation and how you can exploit it because, well, darn, that's just fun. So, and that's kind of one of the hooks in teaching our derivatives class is to get students excited about these pricing anomalies so that they can take advantage of it. Okay, so let's talk a little bit about what the structure of a futures contract is. We're essentially swapping two different commodities. And I really want to make the argument that it is really two commodities. And one of the commodities could be the US dollar. So and I make that distinction because a lot of students, in my experience, get so hung up on it that if we're talking about pork bellies, and I said, well, what's the other side of the contract? And they don't understand that the other side is really US dollars. So we are trading US dollars for pork belly. We are trading US dollars for wheat. We are trading our US dollars, and our US dollars have value, and those values are also going to fluctuate. And so it's something that, again, if you're just starting to get into the futures market, I really want you to start to think about it as two different sides of the coin. And I also teach a lot of foreign exchange, and that becomes very important because you're really exchanging one currency for another. And so students, particularly in those examples, when you're thinking about buying, let's say, a euro, and they get very fixated, well, I'm buying a euro. And well, you're actually trading euros for US dollars. And then once you start to think about other pairs, unless you're thinking about it that way, like a Japanese yen versus a euro is much harder for domestic students to really think about. So, long way of saying that the second commodity that we're trading is really the US dollar, and it is a commodity. And we're going to have an exchange of these products. And one of my favorite analogies is you've got a baker And you've got a farmer. Okay, baker needs wheat. Farmer needs to sell wheat, and baker knows how much wheat is going to be required for the next year. Farmer hopes that they know how much wheat that they're going to be able to sell for the year, how much they're going to be able to produce. And these contracts are a way to say, okay, today we're agreeing on a price at that in 6 months you're going to deliver me X number of bushels of wheat. And at that time period, I'm going to deliver to you USD. Okay. But we don't necessarily know each other. So as I'm a baker and I call up, I don't have a Rolodex of farmers to call and say, I need this much wheat. Rather, they're going to go to the futures market so that they can get this. And one of the beauties of the futures market is it's anonymous. So let's say I'm the baker and Dr. Rowe is the farmer. We would never meet. We would just speak directly with the exchange and the clearinghouse. That's all we were working with. So it's a way for efficient market management, getting people the products that they need from the people who are making them. And we're focusing today on agricultural goods, but there's lots of other ones. There's miners, there's lots of different types of futures contracts.
There's the metals, which is one of the area. Yeah, you mentioned the miners with the gold and the silver, and then energy. I think is the one that, although you have renewable fuel, but we're talking about agricultural ones. But the two other markets that probably behave very similarly would be energy markets and I think the precious metal markets, where you've got cost of carry and the cost of carry may be different among those three different general markets, but I think the economics are pretty similar.
Yeah. And so just so you know, this list here is a list by the CME for the agricultural. And we can see that it's wheat, soybeans, pork cut out. I'm going to give you a nice wink because mine fall into that. My favorites, some of my favorites come into that. I also really like the live cattle, biofuel, and renewable fuel. Now, I want to pay a special shout out to the pork cutouts. We're from Chicago, and Chicago loves their pork belly. Just loves their pork belly. And why? Bacon comes from pork belly. And it's one of those contracts that you can see seasonality for demand. And in the summertime, you're going to see a substantial amount of demand for these types of contracts. And again, from a farmer standpoint, coming back here, this idea of mapping out when they need to deliver the pork belly and trying to capture some of those higher prices in the summer is very important to the farmer. There have been other types of agricultural, products out there. So part of the need for it to be a futures contract, it needs to be able to be stored. So I don't know if you're familiar with this, but eggs and onions used to have futures products. Onions, there is a huge warehouse down in Chicago, and there was being stockpiled tons and tons of onions. And apparently, I think the door broke or something, but all of a sudden you had all of these onions rolling into the Chicago River. So lots of things are needed to be able to make sure that these contracts exist. And the reason why we have these storage is so that we have that continuity of these products, because somebody's going to have to deliver physical goods at some point in the life of the contract. I'm not sure where they store the live cattle. I've always been curious about that. But as somebody who's never needed to buy live cattle, it hasn't really come across. Now, pork belly, that's different. Okay, so we're talking about some of these costs, and this gets lumped into this cost of carry. So our cost of carry consists of interest rates, Dividends, now dividends aren't going to apply here, but I wanted to make sure that we're aware that the cost of carry could be more things. Storage costs. So if you take your pork bellies and they're stored in a warehouse outside of Chicago, it costs money to store them between when the contract is entered and when the product is actually delivered. Financing cost, convenient yield, and the time horizon. So when we look at this equation, it's if you were taking a finance course, this is the time value of money. You would swap out the carry with that interest rate, and it's just looking at prices in the future. We're really now breaking down that cost, and we're being much more considerate of what goes into that contract. So this is why a price today, this PT, is going to typically be lower than the price in the future. Okay. Not always. There are different scenarios and situations where that's not true.
Like in the financial futures, if the dividends are higher than the financing cost, you would, and for years we had the S&P futures at a discount to the S&P index. What's interesting about that is my very first derivatives book, there is a sentence in it that says the dividend yield will never be greater than the risk-free rate. So S&P futures should always trade higher than the index. Never use always in a textbook. So
Especially about the financial
I know that
markets.
professor. I've actually co-authored a professor now, and I couldn't wait to meet him and tell him that. So, and the thing is, that is stuck in my mind. Even 30 plus years later, I'll see, when I see the S&P futures at a discount to the index, the whole arbitrage thing becomes even more difficult to explain. But it doesn't make sense. It just doesn't make sense that you're going to make it up on the dividend side if you hold the expiration. So
Right.
yeah, dividend it's a rare occurrence that you're going to see the futures price at a discount to the spot price. In fact, I can't think in the physical commodity space why you would.
No, I
Uh,
can't either. Unless interest rates go negative, perhaps. But
that's
they
possible. Yeah, that
negative
somehow
interest
you're
rates
getting
would
paid to
have to,
store.
right,
Yeah,
would have to overcome the storage costs. It would have to, there would have to be enough of a spread to make it see in the overall market. Uh, but yeah, and it's funny because I used to say interest rates could never be negative, and boy, was I wrong.
oh
So,
yeah,
yeah,
it does
it,
happen.
it
So
does happen. So this is what should happen, what happens most of the time. And the reason why there's that price discrepancy is that cost of carry. And it's how much does it cost you? And this doesn't have here, and I apologize, it doesn't have transportation costs. So transportation
I think of convenience yield as part of that.
of the
I mean,
transportation.
when I saw convenience yield, I know part of I always think of convenience yield as being partially how close is it.
Mm, yeah.
So, and I've heard it described that way or incorporated within convenience yield before. So,
Well, and that's why
yeah.
all I mean, for the longest time, like Fulton Market. So again, for those of you who are around Chicago, if you're, there's where the trains meet, and the CME is incredibly close to where the trains meet, and not too far away from this Fulton Market. And there would be all these warehouses of these commodities for that physical convenience, so that you're not going miles and miles outside of where the trading is actually happening. It was all physically right there.
Yeah.
Yep.
Now it's a bunch of cool condos and McDonald's headquarters and
Yeah.
things like that.
And amazing
So,
restaurants.
and great restaurants. So,
So a commodity is weirdly what you could consider to be one of the very few examples of perfect competition. So in perfect competition, all of the products have to look exactly the same. Okay, they have to be standardized, they have to be uniform, And the reason why that is because then as a buyer of that commodity, I don't care where I'm getting it from. I am completely indifferent. Everybody's got the same product at the same price. I don't care if it's farmer A versus farmer B. I don't care. I am indifferent. And that indifference is something that really comes up quite a bit in financial theory because if we had a preference, then parity doesn't hold up. But if we don't have that preference and we are indifferent, that's how it forces those part of the reason why those prices are forced together. So again, when we think about perfect competition, for it to be really a perfect market, we need to have many buyers and sellers. And again, in a commodities market, lots of us like to eat pork. Not everybody, but lots of people eat pork. Lots of people eat cattle. I don't think there's a chicken one, but my point is that people, soybeans, corn, wheat, these are all commodities that the majority of people are going to consume. So there's a lot of buyers. There's also a lot of farmers in that are producing these things. Okay. I have celiac disease, so I am not a person who buys wheat. However, that doesn't mean that there is not a ton of other people who do. The other thing about perfect competition is that the commodity or the product has to be the same. And that's key here. Now, I'll pick on your daughter, Maggie. She was in, she's at GWR. I don't know if I should say that. Uh, okay. Well, she's at a university
She's at
and
George Washington University, Washington,
she
D.C.
is.
You can say that. She went.
Okay, good.
Okay.
Uh, but I visited at the Washington, D.C. area, and particularly in the mall, and I'd be curious if she's also experienced this. And you go through the mall, and there's all of these trucks with t-shirts to be sold.
Mhm.
And at the time, and I don't want to tell you how long ago this was, but at the time, the t-shirts were 3 for $10. And one of the things that I noticed about all of these trucks is they were the same designs. Absolutely the same design, same price, every truck three for 10. Now, either they're all working for the same company, or these are point number three, individual firms coming in and out of the market as they buy a truck, right? So buying a truck to go ahead and sell t-shirts on the mall in Washington, D.C. is really a low barrier to enter into the market. You could make the argument that farming isn't perfect competition because there is a higher barrier to get into that market. You need land, you need equipment, you need ability to produce these things. But if you have the land and you have the equipment, then you should be able to freely enter or exit into this market. Okay, so those are the three requirements for perfect competition. Have you ever thought of another product that could be perfect competition?
I mean, it's pretty rare that you find things that are outside the commodity markets like that. But yeah, when you go to specific events like that, it does seem like everybody's charging about the same price for, souvenir t-shirts, etc. Any tourist area you go to, you see the same keychain in 15 different stores, and it's the
Right.
exact same price everywhere. So,
And
you
when
know,
you see that, then you become indifferent who you buy it from.
exactly,
You
exactly.
don't.
Especially and the indifference, the being on vacation in a touristy area, you don't have any allegiance really to any of those retailers. So it definitely does contribute. It definitely is a good example of perfect competition.
So when we have perfect competition, the price that's going to be set is going to be dictated by the overall market. So the firm becomes a price taker. They are not a price setter. They are not Apple, who can set the price for their phones and everybody else will follow suit. They don't have the ability. Whatever the market is charging is what they will charge. And so, for example, in our t-shirt example, if a new truck came in and instead of charging three for $10, they charged five for $10, is anybody going to buy from them? No.
As long as the other truck guys don't walk over with baseball bats and do something about it.
Well, they'll just let them go away because
Then
nobody's buying
that, but that
$5.
eliminates perfect competition.
Yeah, every time,
There you go.
every single time.
But we got to put some reality in there. That's what would happen.
Yeah,
Nobody would be happy about that. So go
nobody would
ahead.
be
Sorry.
happy. So their marginal revenue was going to be directly equal to the price. And this is going to be set by the market supply and demand, not their own supply and demand. And this happens in perfect competition. So from an agricultural standpoint, when we're thinking about the overall market, an individual farmer does not have the ability to set the price. They have to accept the market price, and that becomes actually their optimal revenue because that's where the price is. And for them, and you'll notice that it's a straight line, so they can't really they can't deviate or shouldn't deviate their price. If they go lower, they're going to lose money. And if they go higher, they will also lose money because people won't buy from them. So if a new firm comes in, that will actually force prices down further because you have now shifted the overall supply that comes into the market. So if all of a sudden, I'm trying to think of a commodity that could be on the Hawaiian
Let,
Islands.
I'm going to use Canada, US. So let's
Okay.
say with the tariff stuff,
Okay.
we're not letting wheat come in. And I don't think wheat's a Canadian thing, but we're not letting wheat come in from Canada. And all of a sudden this changes and the supply of wheat this summer is increased by 10 or 20%. That would show up in what we're looking at right now, where there would suddenly be a lot more supply. And that's going to, that would push the price lower to get to a new equilibrium, which would be a lower price.
Yeah, so we go from P1 to P2. And I'd like to also point out that what we're doing is we're reducing the firm's revenue. Okay. So, and getting back to I know you're tongue in cheek about taking the baseball bat to the supplier of shirts, but you could imagine that this is not a desirable thing for the firms that are competing within the market. They do not want new supply in because that will overall reduce the price. And again, all of these firms are price takers. They don't have the ability to market themselves to be different, right? A bushel of wheat is a bushel of wheat. It would be hard to generate interest in a special wheat. Also, if it's special wheat, you couldn't trade it through a futures contract because for a futures contract, and we didn't go through these details, you need to have a large number of contracts that could be bought or sold. If you wanted a unique one, a special one, you could create a forward contract and that'll be traded on the over-the-counter market as opposed to futures, which is traded on the exchange. So it could be done, but it's not going to be as intuitive or natural.
Yeah.
And in that case, when you're on the OTC, the farmer and the baker would actually have to know each other to be able to
Yeah.
create the contract. Okay.
Or have an intermediary that brings them both together, but it's much less efficient than the futures market.
Absolutely. Okay. So sorry, I love these examples. I love to start this with a derivatives class. It gets them, I hope, excited because there is a discrepancy in pricing. So we discussed way back when the idea of a futures contract being equal to the price today multiplied by 1 plus the cost of carry to the time. And we are going to do an example where we're going to assume that the entire cost of carry is at interest rate. Okay, everybody good? And we'll go quick. I promise not to, and you've seen these before. Okay, so the spot price of wheat, we're going to say is 400. The future price is 450. The interest rate is 10%. Now, According to our formula, that cost should actually be $440. Oh my, there's a discrepancy. And what's exciting about a discrepancy is we're going to structure this trade so that you will get that $10 discrepancy every single time. It's completely risk-free because it's contractually obligated. Love those contractual obligations to get you more money. So what we're going to do,
And the just in on the risk part of this working itself out, I think the clearinghouses have a higher credit rating right now than the U.S. government.
oh my goodness.
Yeah, I think the U.S. government's AA, and I think I know the option industry count, the OIC one is AAA, and I think CME Groups is AAA as well.
Wow. So you can feel
So
very safe.
yeah, there's a
That
lot
this,
of, and that's not necessarily true for over-the-counter trades as well. So
no,
sorry to throw the curveball in there, but that's one of the things that you should have in the back of your mind is all of this certain. And I would say in the futures markets with CME as a clearing agent, this is certain.
this is good.
So,
Yep.
yeah.
Um, and we're going to look at the reverse cash and carry next. And there's a small bit of uncertainty there, and we will discuss that as well. Okay. No, I thought that was a good point. Thank you. So we're going to borrow $400 for the year, and we're going to be charged 10%. We're going to go out in the market and buy our wheat. We're going to pay $400 because that's the spot price. We're going to sell a future contract for $450 delivery in 1 year. Once we enter the contract, it costs us nothing. So, Dr. Rowe, how much did we pay to get into this trade?
Nothing and liked it.
We loved it. It
Nothing
cost
and
us
liked it.
nothing. Liked it.
From Caddyshack. You'll get nothing
Yeah.
and like it.
We did, yeah. And we do. Caddyshack was right. We love this, love, love. So, through the magic of time, dee-dee-doo, dee-dee-doo, Scooby-Doo, right?
We fast forward a year.
By a
Yeah.
year, we're going to remove our wheat from storage because remember we had to store it. We're going to deliver our wheat against the futures contract and then we collect $450. We then go back and pay back our loan, collecting a $10 cash flow. Dr. Rowe, how many times would you do this trade?
A bunch. I would even do it with Maggie's tuition money.
I believe it. Why?
Yeah.
Because CME is
I'd be
guaranteed
so certain that I'm going to make money off this that I would not worry about if,
tuition.
although in the real world, if you come across one of these, just do some triple checking because these really should not exist in the real world.
No. And you can imagine if they do, it's not going to be $10. It'll probably be pennies.
Yeah.
And
It's,
somebody's going to come in quickly, a trader who's using a automated system just to pick up those pennies. Doesn't mean it doesn't happen, just it's
we
very,
don't. When I say us, I mean individuals.
right.
That's
Retail. Yeah.
I had too many instances working at the education division of one of the exchanges where people thought they found an arbitrage and realized it and didn't realize it was a non-standard contract. And I don't want to get into the details on that, but sometimes there are things in the financial markets that may appear mispriced. Take a breath and double check things before you actually try to do a trade, because I would say almost always you did not find an arbitrage. There are computers out there that are smarter than us that are
Yep.
looking for them all the time.
And they don't have any emotions. So
No,
when
they
we
don't.
see arbitrage opportunity, we think, Yahoo, life is
Mhm.
good. Um, Computer doesn't care,
No, they don't.
it just executes orders. So reverse cash and carry.
Ooh,
Ooh, and this should say not gold, this should say wheat. Let me
that's all right.
change this here.
It kind of looks like wheat
All right.
because you drew it with green. So there.
I love that. So the spot
Mhm.
price of wheat is 420, the future is 450, our interest rate is 10%. So we know that the future price, they
Yeah.
should be aligned with each other. Okay. So here's where it gets a little dicey. It's a little dicey here. We're going to sell the wheat. So sell something we don't own. We are short the wheat for 420. We are going to then lend out that money at 10%. We're going to buy the wheat futures for delivery in 1 year. Cost us nothing, so our total cash flow is nothing. We're good. We're happy. We're going to collect the proceeds from the loan, so we now have a cash inflow of 462. We're going to accept delivery on that transaction, so it's going to cost us 450, and then we're going to collect the wheat to then go ahead and pay back our short. So the trick here is that we've got a nice cash flow of $12. What makes this not as pure risk-free is that short side. So when we sold short that wheat, the person on the other side can demand that wheat back at any time. So we're assuming that this person has not demanded back that wheat for the entire year. Hopefully that works for us, but we're not as contractually locked in or obligated like we were in the cash and carry. What do you think of that risk, Dr. Rowe?
Yeah, well, the one thing with the risk in this case is the wheat futures contracts. There's a window of time where they're allowed to ask for delivery, and it's as we approach expiration. So that risk is not for the full year, but that risk does exist. I think in the last, let's just say that we're trading December wheat.
Mm,
That as December approaches, there becomes a period of time where delivery is possible. And a lot of speculators start to get out of their positions at that time because they don't want, if they're, and this could be considered a speculative position. So you might unwind your trade a little bit early. The thing is, it says accept deliveries on the futures contract. You could always buy back you've sold the wheat futures contract, you can always buy it back and then offset that with and still lock in some sort of a profit. It might not be the perfect $12 though, but it's going to
right.
be, you're still economically you're going to be in kind of the same place.
You're still going to be ahead. But I'm
Yeah,
glad
yeah.
you brought up the difference between the speculators and the people who are actually doing this for hedging. So we're
Mhm.
not going to be discussing hedging today, but that's a very different position
Yeah.
and point of view to have, being a speculator versus a hedger. So, and we're wrapping up, and we're going to speak a little bit about basic supply and demand, and this is what forces those into those price movements. So we come up with our perfect price, but because of those arbitrage positions, if there's a change in one market, in this case, it'd be the spot price or the spot market and the futures market, those will force each other back into equilibrium. I don't have the diagrams put here, but if we have a change in supply, we're going to then have an offsetting change. Otherwise, in the futures market, that is. Otherwise, those prices are going to be out of line with each other, and we're going to have those arbitrage of the $10 or the $12 difference. So, because of those arbitrage possibilities and the fact that people will want to get into the market, that forces those prices to be in line because technically they are two markets. So when we think about the spot market, that's the market where it's today. I want wheat today, I buy it today. I want wheat in 6 months, I can set the price today and then have it delivered and then I can pay for it in 6 months. That's the future market. And I'm so glad you brought up this idea that as we get closer to expiration, that then starts to eventually will become the spot market
Much. Yeah.
as it expires and there's a like window where it's right on top of each other. But that's the idea here is these are two different markets. Their prices should be in line with each other with the cost of carry. So this needs to have the realization of that cost of carry as we're going from the spot to the forward, and that's where some pricing anomalies will happen. And so that's how, when we hold parity to be true, that forces those prices in line with each other. And it's a unique thing because the agricultural department really is a unique, perfect market, and not most goods fall into this category.
There's very few goods. You can't compare the iPhone and the Galaxy phone or whatever the other phone is. So there.
No, no.
No. It's a great explanation of how the pricing works in a perfectly competitive market and a perfect substitution market. And even with tariff situations and everything else, I don't think, there can be a little bit of an impact on the supply and demand, but within the United States, we can feed ourselves. So if anything, tariffs might actually be a benefit to food prices because they're more expensive to ship things outside of the new US. Maybe, maybe it
Right.
has a reverse. I haven't heard anybody say that, but maybe it has a reverse impact.
Well, and
So,
reducing the cost of carry then.
yep, exactly. So, all right, you get to ask people to hit like and subscribe and stuff because people like you more than me, according to our metrics.
Well, so far we've only asked like 3 people, and
I
one
know.
is the
Uh,
number one fan who voted for you, and then my kids.
yeah.
So,
Kids
and
like you. The number one fan likes me. All
yeah,
right.
and then my kids are a little dicey, so we won't ask them again. So if you like this video, please hit like. And if you haven't already, please hit subscribe so you can see our new content. We are very open to constructive feedback. We take your suggestions seriously. A lot of these videos have come because of requests from students, from people that we've met, and we are happy to oblige. Why? Because it's fun. So thank you very much.